get started. I'll echo Jim's comment a second ago. Happy New Year to everyone. I hope you had a pleasant, peaceful, and relaxing holiday with your friends and family. 23 is in the books. I know a lot of investors are glad to turn a page on what was clearly a unique year in the markets. Jim, in a moment, will share some thoughts on the year that was, and then look ahead, more importantly, to 2024. We're very excited for that. And with that, I will turn it over to our Head of Research and Co-Portfolio Manager, Jim Warner. Jim?
Great, thank you, Jim. And let me share my screen with you all. All right, great. Well, yeah, it was an interesting year, and that's sort of the title of this presentation. Well, that was interesting, and it certainly ended up in a very interesting way with an enormous Santa rally. So we take a little quick look back at 2023. During the year, we had a 10% drawdown. We've written extensively on how there's the 63% chance of that happening, and we got one this year on fears of a recession. And then as those fears sort of evaporated, and I'll get to some of the other drivers here in a second, obviously we had a Santa rally. And this one was unusually large. So we now sit here with the NASDAQ and the S&P at like all-time or near all-time highs. Obviously, for this morning and yesterday, we had a little bit of a pullback. Certainly, as we flip the calendar, there's some rebalancing of portfolios going on. But nevertheless, we're near all-time highs on the stock indices, and then the U.S. aggregate bond index, I think importantly, finished up this year, which is a good sign vis-a-vis what it's done the last few years. And of course, what's fueling the rally was inflation numbers coming in better and better. This is something that we've obviously talked about and anticipated. And what we also expected was interest rates to go lower after they brushed against, the U.S. 10-year yield brushed against 5%. You saw that sell off pretty dramatically. We're basically roughly around 4%, and that kind of feels like a good number right now until we get more economic data. And I think also what this does is it takes some of the worry out of the kind of what I'll call the high interest damage to corporate earnings. And so, we've been a little cautious, quite cautious on names that are subject to whose business models are really require a leverage to grow, or who have a lot of leverage, and their interest expenses will go a lot higher this year versus last year. So this takes a little bit of the pressure off. So as Santa saved the year, I thought it was interesting to take a look at, the S&P bottomed on October 27th, and just the extraordinary rip it had into year end. The S&P was up 16%, and interestingly, the equal weight S&P, which we've talked about, right, which takes out some of the influence of the Magnificent Seven, was actually up more, and that's a great sign that I'll discuss in a second. And the NASDAQ, I mean, it outperformed, but not like earlier in the year. So, much more broader activity across names in the U.S. markets, and then even the rest of the world sort of got into the act. The Nifty in India was up nicely, and the FTSE All World was generally up nicely too. So, obviously, a very, very solid end to what was a very tricky year from an investment standpoint. And, we've talked about this before where, the Magnificent Seven was such an important part of delivering returns, certainly in the early part of the year. But in total, those seven names delivered 60% of the S&P 500's 2023 returns. So that's I'll call that a very narrow market, and that's pretty unusual. But since the market bottomed, and this is really just a visual of, this graph is a visual of the S&P 500 divided by the S&P equal weight index. And so you can see basically as it goes up and to the right, the S&P 500 is outperforming. And then when the market turned, the equal weight started to outperform. And so what this basically means is the rest of the S&P is now starting to play catch up. And I think that this is a really important story that probably could go on for the next 6 months, kind of this relative pullback in the Magnificent Seven and tech maybe more broadly, and then the rest of the market playing catch up. And so we think that that's ultimately good for the market. It's a healthier market. And ultimately, I think we're positioned really well for that. So the other thing I wanted to put into perspective, and beginning of year webinar is usually good for kind of looking back. But if you look at this S&P 500's performance over the last 2 years, we're literally right back where we started. So, we obviously meet with investors all the time and clients. And obviously there was a great deal of frustration over the last 2 years. And it is perfectly reasonable because you can see the volatility that we've had. I mean, if you really step back and think about how extraordinary the last 2 years have been, we've had to deal with kind of enormous stimulus in the system, that wearing off. Then you had massive inflation as a result, and then you had huge surge in interest rates. And to sort of get back to even with 2 years ago after all that is actually pretty impressive and shows a remarkable resilience. Now, I think one of the things that gets us almost even more excited is the big bond comeback that we saw since the bottom of the S&P. And you can see that what basically is driving this is convexity. What we talked about, beginning of 22 was don't have any convexity in your portfolio because you're going to get murdered. And you can see the negative returns that happened across all these various bond indexes. I mean, that's pretty wild that the tilt was down, which is the iShares 20+ year Treasury bond ETF was down 31% in 2022. And you can see that when interest rates turned and finally pivoted, and the market began to believe that the Fed was done raising interest rates, we got this massive equity-like surge of 18%. So we're at a really wild time in history, really, and probably most all of us on this call never saw and traded in the early 1980s. But that was the last time you were able to obtain equity-like returns by taking bond risk. So, and again, just as convexity hurt on the way down, it's now helping on the way up. And so we think that that's really important. And yeah, and you can even see that where I've circled here that the short term or the short duration Treasury bond ETF really didn't participate as very much at all. So if you want returns as interest rates are going lower, you've got to take on duration. So where we sit today is basically what has been in the last 10 years a fairly unusual place, which is 10 or 15 years, is about 4.5% yields on the U.S. aggregate bond index, kind of the broad index for all bonds. And that's a pretty healthy yield. We haven't seen this since about 2008, 2009, which means that you can actually put conservative investors in now relatively safe, bonds and actually earn a decent yield. We haven't seen that in years. So we're excited about that because it really means that we have an alternative to stocks. So let's talk about what comes next in 2024. We think that we're going to continue to see this downward trajectory in inflation. We've talked a lot on previous calls about our thesis on housing. That's starting to fulfill itself. You're now seeing it in the last core PCE number that non-durable goods are also showing deflation now. Previously, it was just durable goods and food and energy, but those are all falling. And so, I think we're starting to see really these prices start to come down economy-wide. So I think that trajectory is good. And I also think that we're going to start to see layoffs pick up. We've talked a little bit about that last month, but you're starting to see this is the 4-week on the chart on the right is the 4-week moving average of continuing claims. And you're starting to see that creep up pretty consistently now. I think we're going to have a pretty steady flow of layoff notices. Don't forget that we have an earnings season that is starting in about a week or two. And so it's very possible that we're going to start to see layoff announcements around that. We don't think that there's some sort of massive cliff coming where there's a ton of job losses, but I just think that there's sort of this gradual, I guess you could call it normalization from the ultra low unemployment levels that we've experienced over the last few years. So obviously what that means, if those two trends continue, inflation down, job losses up, is that the Fed's going to pivot towards cutting. Well, the market, I think, has gotten a little bit ahead of itself, and you're starting to see some of that reaction in the last couple days. But this graph on the right basically is what is the implied policy rate if you were to look out the Treasury curve. And each one of these bars represents a Fed meeting. And so you can see that there's this pretty consistent expectation right now built into the market that the Fed will be cutting and cutting fairly soon. In fact, the market right now basically has a roughly not quite 200 basis points of rate cuts baked into next year. And I have to wonder if this is where maybe the bond market is getting ahead of itself or is too pessimistic on the economy relative to the equity market, because it's really kind of hard to see how we're going to get 200 basis points of cuts unless we have a significant amount of weakness in the economy, which doesn't appear to be right around the corner, given how strong consumer spending continues to be. But this could also be a function of maybe our deflation thesis kicking in. And so, if you've been listening to these calls, you know that I've been talking about how if housing prices correct the way we think they might, we could actually be in a scenario where core PCE goes to zero and maybe possibly even negative. Now, that's not our base case scenario, but it is a possibility. And if in that case, you would have to see pretty dramatic cuts from the Fed. But right now, I think the market's a little bit ahead of itself. In fact, there's even like a 80+% chance the market thinks of a cut at the March meeting, a 25 basis point cut, and we just think that that's a little aggressive at this point. But big picture, the market likes that the Fed is in cutting mode or will be at some point this year, but I think we, just like the Fed and the markets, will be data dependent on just how far they need to go. Now, one other interesting observation we've made or we've discovered is just this surge of money that has gone into the short end of the curve. And this particular graph is of the amount of assets that are in money market funds today. And what's extraordinary, you can see how there was this big pop right at the start of the pandemic. This is really more of a flight to safety. And then it sort of leveled out. And then we got this big surge over the course of the last year and a half as interest rates surged. So people have been piling money up to, we calculate $2.25 trillion has flowed into money markets since the beginning of the pandemic. And we think that some portion of that has to come out. If the Fed starts cutting rates, obviously money markets aren't going to have the same yield. And so investors will start to look for better returns elsewhere. And so we think this could create in 2024 and possibly into 2025 a bullish tailwind for stocks and bonds. So we think that that's an interesting dynamic that we're going to keep an eye on. The other thing we're keeping an eye on is whether value can outperform growth finally in 2024. And what I've put here on this page is a graph of the Russell 1000 growth and the Russell 1000 value indexes forward PEs. And where we sit today is that the Russell growth index has a forward PE of a little over 30 times. And as you can see from this chart and this dark line, this is, elevated relative to past. And for fun, I put in, this is the .com bubble over here on the left. And so we're pretty elevated if you look at periods that, weren't part of, sort of an enormous risk-taking moment in time. And if you look at the green line, this is the Russell value forward PE. It's at just 17 times earnings. So, and if you look at in the bottom graph, it's simply just the ratio of the two. So it's the growth PE of 30 divided by the value PE of 17. And you can see that ratio is creeping up to elevated levels as well. So, this isn't screaming buy value, over growth, but it is saying if you're going to look for value, and if you start to think about if money starts to come out of these money market funds, where's it going to go? And one place people will look for is where there's more value. And so literally the value index is sort of is more attractive, at least on that basis. So, sectors that could benefit include consumer staples, financials, healthcare, utilities, energy. So these are all places where we're spending a lot of time investigating and trying to find new and interesting ideas. Now, I'd be remiss if I didn't say something about the election. And in fact, we are considering doing some sort of a weekly or some kind of with some sort of frequency, kind of a short piece to talk about like what's going on in the election. And I think, obviously there's a lot of questions. There's more questions than answers right now, but it is that information is going to start to come fast and furious. The polls will probably change a lot between now and then. But obviously there are some important, really more longer term policy decisions that we'll need to get our arms wrapped around if there's a change in administration or a pivot in the Biden administration. So all things are important. Everything we're going to approach is from an apolitical standpoint. We're not going to take a stand on anything like that, but we want to keep up with the data. For fun, during periods of elections, I like to look at what people who are willing to bet on the winner of the presidency will be. And you can see from this is from Real Clear Politics. It's a fun site you should check out. But you see the red line is Trump, and people are incrementally think he might be the winner over Biden, which is the blue line, and then you've got all the other competitors down the bottom. I think one of the more interesting, there's a couple of interesting questions that obviously we have no answers to at this point, but I mean, it's a non-zero chance that neither Trump nor Biden are actually the nominees. And so I think the one question that pops up in our heads is, can any Republican beat out Trump for the nomination? And the second really important question is, will a third party candidate emerge? I mean, obviously, Robert Kennedy has already raised his hand there, but you have other folks that have been rumored to possibly be independent candidates like Senator Manchin. So I think that would add obviously a very interesting dynamic to the to the polling. And just for fun to take a look at this question of can any Republican beat Trump? What's really clear is that there's a yes Trump group in the Republican Party and there's a no Trump group. And what's really interesting, if you just look at these polls from New Hampshire, South Carolina, and Iowa, is that basically Trump's at around 50% and the other candidates are around 50%. So the yes Trump, no Trump group in the Republican Party is basically 50-50. And so as we think about like what this could mean, clearly that's going to be a battle that will play out within the Republican Party. And whoever is going to challenge Trump will need to raise a lot of money, which argues that basically that part of the party will have to coalesce around one candidate fairly shortly. And so, as I showed on this page, I mean, Iowa is just, a couple weeks away. New Hampshire comes right after that. Then we have Nevada, and then we go to Nikki Haley's home state of South Carolina. I have a feeling that by the time we get to Super Tuesday on March 5th, there's one no Trump candidate to go against Trump. But a lot's going to happen in the next couple of months. So, okay, let's talk about portfolio positioning. We actually made 0 changes to global vigilance during the month of December. The basic reason is that virtually everything worked, just like it did across almost the entire market, but our positions were really did benefit from that rally considerably. We would not, we would not be surprised at all if we have a 5% pullback from here. Obviously we saw a little sell-off yesterday, and it's continuing today, particularly in tech. But after big runs like that, it's totally normal to have a pullback. We were able to trim some of our biggest winners, and we were able to do this in a tax-friendly manner. Some of our biggest winners were, some of the like Q-Tech, Microsoft, Google. They had big gains, but we were able to offset it with losses that we had taken previously in the year. So I think that's an important point to make because some investment managers only do tax trading at the very end of the year. We basically do it throughout the entire year, which does, I think, give us some flexibility that maybe others don't have. I think where we sit today, we like where our portfolio is. And I think we're probably going to stick with the kind of asset allocation that we have now, roughly around 55-60% stocks versus bonds. We are continuing to barbell our stocks with growthy names as well as value names that we think can be part of that group that catches up this year. And we're also, wide-eyed and watching closely to see if the economy deteriorates, significantly. And so I think we're in a very good position for that. We'd obviously make some changes tactically, which is normal, but we're keeping our eye on that ball, as we mentioned earlier. And I think if with these laggards that we just discussed catch up, we're in a really, really good position for that. The last slide I'll put up, and then we can go to questions, Jim, is the top 5 winners that we had in our portfolio really really symbolize the kind of patience and perseverance that was required this year. And for those that are invested with us, we appreciate your patience. But we were really richly rewarded on particularly our mortgage REIT bets, which we've talked about a lot, with the decline in interest rates and interest rate volatility, as well as some compression in mortgage-backed securities. We had some fantastic returns. So let me leave it there, Jim, and let's take a few questions.
Great. Thank you, Jim. Yeah, we have a number of questions in the queue here. First up, historically, the Santa rally goes to the first 4 days of the next year. With the downturns in the first days of 2024, history tells us that does not portend well for 2024. What do you think?
Yeah, I don't believe in any of these types of statistics. I think every year's, there's a lot going on in the economy, and then there's 360 days left in the year. A lot can happen. So I don't really take any any relief or any concern on what happens in the first few days of any year.
Okay, good. Next question. Can you speak for a moment about gold and precious metals for 2024?
Yeah, I mean, we're pretty optimistic in gold for a couple of reasons. One is, we think the dollar stands to weaken, which would be great for gold. We also think that if our worst case scenario plays out and there's deflation, gold is a store of value and will do very, very well. So we like that. We like it as both a hedge in the portfolio and also as it should track the interest rates down.
Okay. Next question. Given that interest rates are expected to decline, is it likely that you will increase equity exposure in 2024?
Well, the real question is, what does the long end of the curve do? And why are we cutting rates? So if we're cutting rates because the economy is really weak, then stocks are going to get hit. And you're going to have to find places to hide in bonds. And bonds will do quite well, frankly. And so that's an okay scenario. If the interest rates are declining because there's deflation, that's also not good for stocks. But if interest rates decline from here, and obviously, the market has already reacted to some extent before the Fed. So nobody's waiting around for the Fed. But as the Fed gets along to, cutting and catching up to the market, lower interest rates, provided that we have some sort of a soft landing and we don't have the prior 2 scenarios I just laid out don't occur, then it's terrific for stocks. So, I think what we're going to see this year is, I think the first half, I think we're going to rally here. Obviously, we're having a little bit of a pullback, digestion, et cetera. I think the first, first quarter or so should be fine. Beyond that, it really is data dependent on where rates go. I mean, the long end of the curve could just sit here at 4% for all I know for the rest of the year, which is fine for bonds and fine for stocks. It's really more about, does the data really change to create a material weakness in the economy, or show material weakness or material strength? And right now the economy is fine, but there are definitely areas where the labor market's getting a little weaker. And, and so how does that all play out? That's all stuff that will play into how we tactically think about allocating across asset classes.
Okay, next question. How do you expect reduced consumer spending will affect equities' total return in 2024?
Well, so we've been surprised at how strong the consumer has remained. There are parts, though, of the consumer world that are actually quite weak, and some parts that are still are very strong, like services and travel and entertainment, that sort of thing. The weak being, appliances and that sort of world. The pull forward effect from the pandemic purchases is still impacting that part of the economy. But generally speaking, consumer spending is hanging in there very well. If we could, to put on a rosy scenario, if the labor market doesn't fall apart and just weakens a little bit, and interest rates are lower, well, then that should be really, really good for consumer spending. And I think that could potentially be the base case. Plus, if deflation kicks in, I'm not sure that's such a bad thing. Given the elevated prices that we've seen over the last couple of years, real wages would actually go up, and therefore that should be good for the consumer spending, and I'd say net probably good for equities overall. So yeah, there's definitely a positive scenario here. So I don't want to come across too pessimistic, but yeah, I mean, the consumer spending does hold a substantial number of the keys to the economy, and it's like 68% of the economy. So yeah, that is the right question to ask, and it's the right thing to be focused on.
Okay. And then one other question, back to gold for a moment, just on how you're positioning gold in the portfolio, security-wise.
Yeah, so depending on the portfolio, we either own the GLD or we own Freeport, which is a gold miner, or not Freeport. We sometimes own Barrick in some of our portfolios, which is a gold miner. But anyway, the point is that it's not a huge position in the portfolio. It is there. We could size it up if the conditions warranted. But right now, it kind of works as a nice diversifier, if more than anything else.
Okay. That wraps up questions. If anyone else wants to ask a final question here in the last couple of moments, please go ahead and do that. And Jim, I'll just ask as we get ready to start a brand new year, as always, a lot of times strategists like yourself are asked this very similar question. And I know inflation, you spoke about it at length, and pardon me, deflation. What other potential black swan events kind of have you thinking might cause some concern, could go sideways for us here in 2024? That's an election year. There's lots going on. What are the thoughts you have on that?
Yeah, so obviously the tricky thing with black swan events is that they're extremely difficult to predict. Otherwise, they wouldn't be black swans. But the first place you'd obviously go is to the Middle East. I think that this disruption of shipping in the Red Sea is a problem. I think it's a solvable problem, but clearly any sort of big disruption, particularly to the oil trade, could cause oil prices to surge. We're taking steps in the portfolio to have exposure to energy companies such that we would benefit from that, but that would be damaging from an economic standpoint. Maybe not. So we'll have to wait and watch what happens there. Clearly, the whole Israeli-Hamas situation really raises the question of global terrorism. If this becomes a thing, and what kind of disruption could that have, particularly to transportation? And so that's something that you can't predict, but we're watching closely. We don't really have I don't have a great view on when or if Russia, and Ukraine will have some sort of a peace treaty. But what troubles me there is that the Russians have changed their tactics recently to use artillery to just destroy infrastructure. And they've been doing it before, but now they're actively targeting cities and trying to level the country. And they've also been targeting a lot of the agricultural infrastructure, which is what Ukraine really does provide to the world. It's one of the largest providers of grain, for example, to the world. And so what does that do to agricultural markets and food prices? That's something else to watch for closely. Beyond that, I worry a little bit about violence around the election, and whether or not what happens if one side loses. Are we going to have violence? So that's something that again can't predict, and you really hope that doesn't happen. And then obviously, what's going to happen with with the southern border and the consequences of that being wide open for couple of years now. We haven't seen really. You're starting to see, cities get bogged down by these migrants. So what impacts does that have on crime and the economy and that sort of thing? I mean, these are all things on our minds. But I think we have a big resilient economy. We have a Fed that would drop interest rates at an instant to keep liquidity in the market. And so, I do believe that there are, safety levers that could be pulled, if any of those black swan events were to occur. So, we'll just have to be prepared. Right now, frankly, we're not taking tons of risk in the portfolio. So, if any sort of event were to create a big pullback, we actually have, quite a bit of dry powder we could use to take advantage of it. So, it's a tough question to answer. It's a good question, but it's always something that we have on the back of our minds as to, what would we do if this were to happen? And to be sure, if anything like that it does happen, we'll be very transparent on how we're changing the portfolio, what we think, and certainly we keep you all informed.
All right, there are no other questions in the queue. Jim, thank you as always for leading this call, and to all of our advisors and clients joining us this afternoon, thank you again for joining us for this month's installment. As always, remain committed to helping you and your clients achieve their financial goals, and we're grateful for the trust you've placed in us to manage your irreplaceable wealth and that wealth of your clients as well. So thank you. Have a great month. We're here. We'll look forward to connecting with you throughout the first part of this year. And should you have any questions at all, feel free to reach out to us directly. Thank you. We'll look forward to seeing you soon.
Happy New Year.
Happy New Year.